Welcome, everyone. It's the top of the hour. I am Mark Trice, financial advisor here at ClearVista Financial. I'm joined, as always, by fellow financial advisor Jesse Hamilton.
Hey, everybody. Welcome.
This is the June 2024 market update, and we thank you for joining us. We made it through April and May, and we've got a lot of talk about as some shifts are changing, and we are looking at how the market is continuing to improve. So let's go ahead and jump into our agenda for today. Jesse, go ahead and kick us off.
Sure. Most of our normal things today, we're going to look at the index performance for May of 2024, all of our four major indexes that we usually cover. We'll make our comments on the markets and the current state of the economy and our outlook moving forward. And then, as requested, a special portion of our program today will be focused on election years historically and how the stock and bond markets have performed as far as the indexes.
I've been promising our clients that we talk about this, and this time we actually are going to do it.
That's right.
Anyway, so we have a new and improved way of interacting with you. You can send your questions to us live at info@clearvistafinancial.com, and we'll answer them towards the end of the program. You can also text us at our text line at 254-282-0495. And Jesse, I'm going to mute the camera here so that people can see the more real estate on the screen.
Perfect.
And we'll keep jumping in right into the S&P 500.
Great. So here's our first index of the day, the S&P 500. This is our large cap index. Just a reminder for anyone who's new to these webinars, this is called a candle chart. Each day is a trading day. Red candles are down days and green candles are up days. So the S&P 500 gained 4.80% in May. It did gain back those losses from April, which we like to see. It was generally a positive uptrend until that high there in the middle of the chart on May 23rd.
That was an all-time high.
That was an all-time high. It didn't close there, but it reached an all-time high intraday at 53.41. We have since eclipsed that yesterday, actually, but this is the end of the month data. And then, of course, it pulled back slightly and ended the month there. The last candle you'll see is a little bit of a green bullish candle with some buying pressure at the end of the day. Large caps continued to perform well despite hesitation from the Fed about an interest rate cut.
They just won't cut interest rates. But we're going to talk about that a little bit later in the program today.
Yes.
And we'll tell you why we think they're not cutting interest rates.
So here's the NASDAQ 100, which is our tech-heavy index, cap-weighted and heavily influenced by the largest companies in the U.S. market. It does tend to be more volatile than the S&P 500. And it proved in May to do that. The index closed 6.89% in the positive.
That's a good month.
For the month of May. More than outperforming those losses from April. And it was quite volatile with a swing from the trough to the peak there, 9.48% from May 1st to May 28th. That's a pretty aggressive swing.
Yeah.
So a combination of several things here, earnings, government support, a lot of
the
excitement.
a lot of the tech companies beat earnings and so forth, which you have to take those earnings reports with a grain of salt because they're always going to be positive.
Right.
I've never really seen a very negative earnings report from a public company. That's the way they're designed. So you kind of have to see how much they beat the estimates and so on. But that was generally positive in the month of May.
Mm-hmm. There's kind of a fascinating event there on the last day of the month. That we call that a hammer. It's the red candle with a big stem at the end of it. This is a bearish hammer because it's red, but it shows that investors came back and put in orders as the day went on, which drove the price back up close to where it opened, which is very interesting.
Yeah.
If you looked at a daily chart of this, it would look like a smile or a parabola.
Okay, during the day, the minute chart, if you will, and stuff like that. That morning opened up down quite a bit.
Yeah.
And then just continued to improve. Buyers entered the market throughout the day and ended the month on I think, a positive note there.
Mm-hmm. Here's the Russell 2000 small cap index. It was up 5.04% in May, slightly eclipsing the large cap index. That was 4.8. This is good news for market breadth. They were both going up at the same time. Investors did seem to be more favorable of small caps in May, which is what we haven't seen in previous months. And then, of course, it pulled back almost 4% from the high in the mid-month to the low on May 29th.
So we're going to talk more about small caps versus large caps here in just a minute.
Yes.
So that was a positive sign in May. We like that, like to see that.
Mm-hmm. And lastly, we'll look at the long-term Treasury Index, which was up 2.53% in May. And Mark, this is good news because it is the first positive return during a month that we have had this year for this index.
Okay.
So yeah,
after being down for the last, what, 2.5 years?
Yeah.
Is that right?
We'll cover the long-term performance in just a moment here, but yeah, we've been sharing negative returns with you every month since 2023, and this is a positive month.
Yeah.
So several gaps up and down, really choppy trading on this chart. It shows how volatile this index can be, which a lot of people don't understand.
And a lot of people are still trying to figure out, a lot of bond managers are still trying to figure out what's going to happen with interest rates, because there is that converse relationship between interest rates and the yield, and the price of the bond. Excuse me, I didn't mean to mess it up. But so that's something that we're continuing to watch. Bonds still, we think, are still a very volatile and not so safe part of your portfolio. Our clients own very few bonds right now, but that's something you should talk with your personal financial advisor about.
That's right.
Okay, so here's our disclosures. And I've tried this time to provide a little music while you read the disclosures. Okay, let's move it on.
So here is the same chart that I've been showing every month this year. It's a 2.5-year look back between the S&P 500 in green and red and the Russell 2000 in blue. And I've updated it to show the most current data through the end of May. And like I said, we've been tracking this for quite a while now because these indexes tracked together throughout 2022, but then they diverged in March of 2023, which is over a year ago. And we've seen brief glimmers of hope where the small cap index tried to outperform, but it still is lagging behind. In order to see true market breadth, we need these lines to be moving in tandem, or even the small cap blue line to be on top of the large cap line.
Yeah, and so I'm gonna take the arrow here, or maybe the laser spotlight here, or the laser. Going back to 2021, you see the blue line is really above the S&P line. And that's when the economy was really roaring and moving forward very well toward the end of 2019. Of course, that was pre-COVID, and those things changed when COVID happened. But we like to see these two, the blue line and the green and red line, to converge. And because we need to see small caps really leading the way for a very broad-based, healthy market, if you will.
Mm-hmm. So our next chart here is kind of a drill down on those different indexes. I thought it was a really good way to look at it. The way this works is the S&P 500 is the flat green line. So that's our baseline, is the large cap index.
Okay.
And all the other indexes are, the difference between them is shown via the colors here.
Okay, so you're looking at the S&P 400, which is kind of more of a mid cap.
The blue line there is mid cap. And then the yellow and red lines are small caps and micro caps. So mid caps have been outperforming large caps, which is very interesting. And then the small and micros lag. And I have some references here for what size companies we're talking about.
Yeah, so for reference, a small cap company is on the S&P 600 has an average capitalization between 1 billion and 6.7 billion in market cap. Micro caps generally have a market cap below 1 billion. So if you ever wanted to know, that's kind of the cutoffs there. Small caps are 1 to 6, almost $7 billion in capitalization.
Which doesn't seem so small, but it's tiny compared to the big dogs.
Right, exactly. Especially when you start having companies that are over $1 trillion in market
Yes,
cap.
the largest ones are now measured in multiple trillions.
Yes, yes. Okay, let's go. Keep moving on here.
So this is what we like to show sometimes as a chart that displays the number of stocks, the percentage of stocks that are above their 200-day moving average. So in technical analysis, the 200-day moving average is a sign of strength and bullishness. And this shows the whole month of May. And it closed, what is that? Just at 57%.
54.
54%.
Yes, 54.85.
So we'd like to see this stay above 60. And unfortunately, we didn't see that in May. And we don't expect this indicator to break out in either direction until the Fed makes a move.
Yeah, and we're going to talk about what we think the probability of the Federal Reserve cutting rates. Of course, we don't have a crystal ball, and we don't know who's really pulling the puppet strings
Right.
at the Fed. But we do like to see it above 60. We did a little bit in May there, pulled back towards the end, but this is still a nice recovery from the month of April.
So I wish I had a year-long chart. I can show that next month, but this has really just moved sideways all year long because they can't make up their mind.
Yeah, so the market's still struggling a little bit. Let's kind of go back and refresh ourselves. We talked about over the last several meetings about market indexes and their time to recovery when they're coming out of a bear market.
Mm-hmm.
So you can see the NASDAQ, Jesse.
These are updated as of the end of May.
End of May. NASDAQ Composite Index is up 11% year to date. We regained that all-time high, if you will, or back in November of it peaked in November of 2021. It recovered early this year. The S&P 500 is somewhat the same. It peaked in November or in January of 2022. It recovered in January 2024.
Mm-hmm.
Full 2 years. We need to update that, Jesse, next time.
Sure.
The long-term Treasury Index still down 8.5%.
But here's the big one. Since at the peak.
Since the peak in April of 2020, this is right after the beginning of COVID, the long-term Treasury Index is down 41%. And that's something that a lot of people don't realize, and they're wondering why their balanced portfolio is not performing well as the major stock indexes. So we use a moderate portfolio index to kind of use as our benchmark. It still has not recovered from November of 2021, still down 7.6%. Year to date, that index is up a little over 2%. Mm-hmm. And Jesse, tell them about the S&P 500 equal weight.
So the S&P 500 equal weight is just where each of the 500 companies gets an equal vote, not based on their size, but just one vote per company. So it lets us see a little bit different measure of the breadth of the market. And luckily, this is up 6.6%, which is good news. And that tells me that the smaller players in the S&P 500 are also going up.
Yeah, that's good news. Equal weight, remember, it's like the Senate. Every state gets 2 senators.
Right.
No matter their size. This is the same for the equal weighted index. All right. Ready to jump into the macroeconomic outlook, Jesse?
That's right. So just a reminder, we would love to hear your questions live. We have our phones right here on us. They are logged into the texting platform. So send us a message with your questions. If we can't get to it today, we will respond within 24 hours. You can also shoot us an email at info@clearvistafinancial.com. That text line, once again, 254-282-0495.
Okay, so jumping right in, let's talk about gross domestic product. This is a measure of the strength of the economy, how much it's growing. The economy grew at a slower pace in the first quarter than was initially reported. We've got new data in May that updated and revised the first quarter gross domestic product. It rose 1.3% in the first 3 months, and that's annualized. That means that if the same pace continues on for the next 12 months, the economy will grow at a 1.3% annualized rate.
So nothing spectacular.
Nothing spectacular, although during some previous administrations that was considered phenomenal, which is not. Now, the estimate was 1.6. So the Bureau of Economic Analysis figures that were published last week um, showed that change, revisions, and you're going to see a lot of this in an election year. Okay. I've been studying economics for a long time. And in election years, typically about 6 weeks to a few months after the election, all the previous year's economic data gets updated and it's usually revised downward. Why is that? I mean, it's kind of suspicious when it's revised downward. It's like somebody wanted to make sure that things were looking better than they actually were. The economy's main growth engine, personal spending, that rose 2% in the first quarter versus the previous estimate of 2.5%.
Are we spending money that we don't have, though?
Well, yeah, there is, but the numbers underscore a loss of momentum to start the year out after a continual upside surprises in 2023. High interest rates, waning pandemic era savings, in other words, people are spending down their pandemic savings, and slower income growth are some of the key factors weighing on those households. Consumer spending was marked down as outlays for goods, particularly cars and automobiles, were a lot softer than expected. The federal government spending slowed, which is kind of a surprise. They always like to spend money. Imports picked up a little bit, but net exports subtracted from the growth for the first time in 2 years. So we are exporting fewer and fewer goods. So anyway, lots of mixed signals here that, and economists have pointed to the strength in this metric as a reason to believe that demand is still strong, even if the headline GDP figure looks weak by comparison. So that's the GDP. Economy is slowing down just a bit, okay? And then the Consumer Price Index, the CPI, rose 0.3 in April. We're not supposed to be doing this. This is supposed to be slowing down. This is a measure of inflation. And it was expected, though, that to rise 0.4% in a month. So that was a downward surprise that we didn't have inflation increasing as much as we thought we were.
But it's still going up.
Yes, the CPI is still up 3.4% from a year ago. Now, I'm going to make some comments here in a minute about that. Energy prices rose 1.1% in April. That's the price at the pump's going up. I paid like a $3.40 a gallon the other day. And this is going into the high driving season for a lot of folks taking vacations and things. But, the fact that there wasn't a huge surprise actually helped markets out this month. That's something that's important to remember. But here's the thing, and I was talking with another economist just last week, and we were talking about how inflation is measured, how they come with the annualized rate and so forth. The Federal Reserve has a target of 2% annualized inflation.
Okay.
And even if, and the print for the inflation's coming out next week, even if we have 0% growth in the CPI all the way through October, this was right before the election, we still will not hit that Fed mandated target of 2%. Annualized inflation is still going to be north of 2% for some time to come. That's if we don't have any inflation growth at all, but we are, right?
So 2% annualized divided by 12 months, that comparable figure would be 0.16 per month, right?
Right.
That's our target.
Yes, 0.16 per month. And you saw right there in April it was 0.3.
Double that.
Yeah, double that. So it's inflation is here, is sticky. It's going to continue to be a problem. The most troubling thing about the recent inflation report was the part they talk about the super core, and this is what the economists at the Fed look at. That measure did jump 0.4% in April, driven by higher prices for motor vehicle insurance and financial services. In the last 12 months, that measure, the super core part of inflation, is up 4.9%, and it's been accelerating as of late, up at a 6.3 annualized rate in the last 3 months. So inflation remains stubbornly high. The other opposite effect of this is it's a little bit confusing to the Fed, is that workers are no longer being compensated for the high inflation. Real hourly hourly earnings declined 0.2% in April. And these earnings are only up 0.5% in the last year. That's a headwind for future growth in consumer spending, which has been driving the gross domestic product
Right. We just talked
increase.
about that last
That's right.
slide.
So right now, we don't see that the Fed they have very little reason to start cutting interest rates at this point. How they respond to the incoming economic data in the months ahead could determine whether or not we repeat the inflationary 1970s. And many of you that are listening, you were growing up during that time. You know what that was like and how much of a struggle that created for your parents. And it's something that we're hopeful that we can avoid again. But if the government keeps spending money like it's made on trees or grows on trees, we've got some problems ahead.
We get a lot of questions about real estate, Mark, so I thought I'd throw in some existing home sales data.
Yeah, and existing home sales continue to decline in April, 1.9% versus a year ago. It's the culprit here is really mortgage rates. And I think that affordability is a big concern for buyers. It costs about 30% more for your monthly mortgage payment for the same house as it did 2 years ago. Now that's a big deal. So assuming a 20% down payment, the rise in mortgage rates since the Federal Reserve began its current tightening cycle in March of 22.
That was the peak, right?
Yeah, it's a peak. I'm sorry, I got the wrong number. It's a 42% increase in monthly payments on
So
the
the same
mortgage.
house, if you wanted to buy it, costs 42% on a monthly basis.
That's right. And so that's really makes it hard for people, the average family, to afford the average house.
Right.
And I wrote a lot about home affordability back when I was in college, and this is a big problem. That really is going to slow that turnover in the housing. Okay, the producer price index. Now this rose 0.5% in April, and the market didn't like this. This is the index that's used to talk about the inflation and the core components for production. That rose 0.5 in April, and it's been accelerating as well as of late.
It's really telling because if it costs more for a company to make something, they're not just going to eat that cost. They're going to give it to you.
Yep, they're going to pass it along, and that means that probably rates are going to stay higher for longer. I don't anticipate the Fed's going to raise rates, but the reality is we're in an election year, and even though no one will admit it, the Fed does tend to have a tendency to be a political animal. And I think maybe they'll have some pressure to cut rates. Especially, I don't think we're going to see them cut rates unless we see a drastic downturn in the health of the economy. So the things to watch for, and I know employment figures are coming out tomorrow for the month of May, declining employment. Okay, I'm reading a lot of articles today that the recent increases in employment numbers have been because companies are hiring illegal aliens.
Yes, I saw that chart too. It's kind of concerning.
And the actual hiring of U.S. citizens is dropping.
It's flat since 2018.
So we're hiring cheap labor and it's taking jobs away from U.S. citizens. But that is where you're seeing the majority of the growth in employment is from hiring of illegal aliens that are crossing the border by droves in the South and the North. So this is something that's going to put more pressure on the Fed to keep rates higher for longer. And that's until we start seeing these numbers go down and we see employment drop, we're going to see the Fed hang on tight to those higher for longer rates.
That's right.
All right. Well, guess what, Jesse? And what was the thing I was reading the other day? I'll think of it here in a second.
Okay.
Let's jump in. The meme stocks have been in the news again.
Yeah, I just wanted to post a quick warning here. You probably know exactly what I'm talking about. I'm not going to mention the company or companies involved. But we saw an additional rise in kind of the chaos and calamity of the meme stock world in May, fueled by the same individual who posted on X for the first time in 3 years.
I'm not even gonna give his handle name. And this time, hey, the regulators are saying, hey, this guy's manipulating the market.
Yeah, they're trying to kick him off the platform.
If you jump in, we're just giving you a warning, guys. if you decide to jump in and participate in one of these meme stocks that are going up 50 and 70% a
A
day,
day.
you're getting sucked in and you probably are going to lose your money. I'm just trying to keep you from losing your money. These stocks are big money being put into companies that do not have the fundamental values that the price of the stock is showing us and the data, and they're being manipulated by one guy who's going in and putting in hundreds of millions of dollars into some of these stocks, buying them, causing the price to go up rapidly, which sucks in a lot of people that are duped
Mm-hmm.
and pushing the price up higher. And it really, Jesse, is a pump and dump type scheme. And I hope the regulators crack down on them. Yeah, that one stock I was looking at, what's it down from that one day that the guy started posting?
It dropped 50% in a day and 71% in eight days.
It's your money that you decided to throw at this little risky scheme that's going on here. So be wary of that. If you're on certain social media platforms and you're seeing this, everybody jump in, let's go stick it to the man. You're probably you run a high risk of losing all your money. So let's stay away from those things. We wanted to bring it up because it's in the news now, and we're seeing the same thing: people losing a lot of money.
And when you see a certain individual that we won't name profiting $210 million, you're going to say, I want a piece of that.
He's the only one that's getting rich.
And the company.
And the company. Yeah, the insiders in the company are selling their stocks and stuff like that too.
Yeah.
You won't get to participate in that. So JC, let's talk a little bit about interest rates.
Yep.
Because they're still up at that range, 5.25% to 5.5% for the overnight Fed funds rate. And this time it's a little bit different in that the Federal Reserve is paying the big banks to keep money in reserves, and they're paying them for it. This is not like before the great financial crisis, where the Fed needed to lend to them and so forth overnight so that they could make interest and pass it on to the consumers.
Mm-hmm.
That's not happening. That's why you see it, the big international banks and national banks, they're not paying anything for deposits, for deposit customers and things.
Seems almost criminal to me, but
well, we won't give our opinions on this here. But high interest rates are still affecting Americans.
Yes, here's the chart that explains why it's so expensive to borrow money right now. Here's the yield curve. It's still inverted, and that started in March of 2022, which means we're in month number 27 of inverted yield curve. That's over.
So normally we
2 years.
see the yield curve look like more like a hockey stick, but going the other direction. Lower rates at the end. Excuse me, I didn't mean to do that. Let me go back here. And the 10-year Treasury that we like to look at is still around 4.5%. That's what a lot of your mortgage rates and so forth. But typically, we don't see these lower duration Treasuries be higher than the longer term Treasuries.
Yes.
And that's the problem. And when, as we said before, when we see an inverted yield curve like this, it's typically a precursor to a recession. Folks, I don't know if that's going to be the case this time, because everything is manipulated more so than it ever has been.
Right.
And, we just like to be in a position that we can help our clients manage their investments should that house of cards start to crumble.
And collect some yield while short-term rates are
right,
high.
you can do that, yeah. And short-term rates are higher. That's some places that clients can put some of their money.
Mm-hmm.
But you'll see, you see here that the 1-month yield is just below 5.5%, while the 30-year yield is around 4.6%. So that's, this doesn't predict the future. All we can say is this is, we can't say that it's a foreshadowing of significant financial trouble, but it's just something we watch. And that in the previous umpteen different recessions, that typically has been a precursor to a recession. So with all the stimulus that the government's pouring out there and stuff, they're clearly trying to prop something up. But right now we're not seeing the effects of this inverted yield curve just yet.
Right. So here's the 10-year Treasury the yield on it. So when you go in to apply for a car loan or a mortgage, something like that, this is closely related to your cost. And you can kind of see the trickle down of the pricing. It peaked there in what was that, October of 23.
Mm-hmm.
It does take time for it to make its way all the way down to your personal budget. But notice what's been happening this year so far.
And rising.
Yes.
And but not to worry. I read an article that a particular mortgage wholesale company today is bringing back the 100% financing. Where have we heard this before? Surely that can't.
About 15 years ago.
Why, folks? Why do we not learn from history? I mean, history is the study of how we don't learn from history. That's what it is. And so we're repeating that fiasco of the 2005 to 2007.
We're not suggesting that's going to happen again, but
There's a company out there that's offering 100% financing. Okay, so maybe they weren't in existence then. They just didn't realize that happened.
This brilliant new idea.
Yeah, let's let people put no money down when they buy a home, and that will work out great. So we don't think it will. So we're watching that as well. So I know you've been asking for this because we get a lot of calls every year, election year, particularly in presidential years. Clients come to us or prospective clients come to us and they're worried about their portfolio in an election year because everybody watches their late night television programs that predict the end of the world if so and so gets elected, or if we elect this so and so. The end of the world will come and everything will lose value.
We multiple times, probably a year, we hear if so and so gets elected, that's when I'll put my money to work.
And we're just telling folks, hey, take a deep breath. Take a deep breath. Make sure that you realize that, and this is why we're focusing on this data we're about to present. There's headlines everywhere, but that's just headlines, and the headlines are designed to get your attention. They don't really make a whole lot of sense. But we've got some mid-year market review from Signet Financial Management. They compiled a great set of charts, and we've seen several of these. These are the best ones that we've seen so far. There's a number of different studies out there that show market performance before the election, after the election, the year following the election, and if a Republican's in the White House or a Democrat's in the White House, it doesn't change a whole lot. And so I want to tell folks, just take a deep breath. We'll get through this election. Yes, elections do matter, but we found historically that they don't have a lot of impact on your portfolio.
Right.
So if you want to read this entire article, we'd be glad to send it to you, but just send us a text or send us an email there to info@ClearVista Financial, and we'll send it off to you. And we need to make sure we get that compliance approved before we send it to anybody.
Right.
As usual, these are not investment recommendations, just merely an illustration to show some index performance during presidential years. So here we go. Yeah, go ahead, Jesse.
I was going to say this chart goes back to 1928 and shows every single election year. And you can see which years were up and which years were down. And we just want to point out that the 4 down years were the Great Depression, World War II, the tech bubble, and the Great Financial Crisis. So that's external circumstances that apply to the market performance.
Yeah, all external situations that had nothing to do with the presidential election.
Right.
Okay, so the Great Depression, we all know about that. The end of World War II, a lot of inflation, a lot of young men and women coming back from the war fronts. The whole mechanism of production changed during that time. Those were years in which heavy pressure to spend less. And then, of course, we remember the 2000 tech bubble that burst. I mean, companies that were not making any money at all were listing on the public markets and selling for multiples and multiples of zero.
Right.
And then, of course, the great financial crisis back in 2008. All these things were going on in presidential years. And yes, those were external factors, had nothing to do with the presidential election. Now, we'll tell you that potentially these markets had an impact
right
on the presidential election, but not the other way around. Okay, let's look at this a different way.
So here's a comparison of the calendar years that lost money versus made money for non-election years and election years. Once again, we're going to use the S&P 500. These are all large cap figures, by the way.
All right.
The disclosure there at the bottom shows the data where we got it from.
Right.
This does not provide any guarantees of what it might look like moving through the year, but historically, each down year was caused by these major historic events, not elections.
Right. So 70% of the time in a non-election year, the market was up. 30%, that's about 22 years, the market was down.
But the interesting one is the pie chart on the right.
Right. So during election years, 83% of those election years were positive, and only 17%, those 4 years we talked about, were negative. Now, this is not a predictor of anything. Don't go out and invest because it could be that the gains that we've already had in the markets are the positive part of the market.
That's right.
So this is not provide any guarantees whatsoever what the index might look like as we move through 2024. But historically, each down year was caused by historic economic events, not elections.
Right.
And so, only 4 of those 24 presidential election years did we see data that was negative. And those were really caused by external factors that had nothing to do with the election, more so maybe worldwide events and the markets themselves.
Right. So this time of year, we hear the old investing adage, sell in May and
Sell
go
in
away.
May and go away. I know that's in the stock market almanac out there, sell in May and go away. And historically, that just kind of meant that that's when the traders on Wall Street would take their summer vacation and not be working. And sometimes there's a volatility during the summertime.
Right. So this bar chart here shows the 2 6-month periods between non-election and election years. So the sell in May and go away period, May to October, and then the period where people think they can make more money, November to April. Historically, May to October period for the S&P is higher during election years, and then November to April is slightly lower. That's just the historical data.
Okay, all right. But if you're at a barbecue this summer and someone says sell in May and go away, tell them also there's also a phenomenon known as mummies to mummies, or turkey to tax. We've never heard not heard that before. Turkey to tax is that November to April time frame and stuff. But we're still saying the same thing here, folks. Markets and election years typically don't change that much. Okay.
Here's the same chart, but for bonds.
Okay.
Uses the SBBI government bond index and, of course, the Bloomberg aggregate bond index. But the data is surprisingly the same here. So the returns historically for May to October during election years are slightly lower, are higher, and then slightly lower for November to April.
Okay. All right. So how does this all impact us? Well, we're going to get into that. So with all this conflicting data, the market's rebounding, seems to be. We've moved into a bull market now from the bear market that we had the last year or so.
Indexes approaching and hitting all-time highs, but at the same time, we're telling you about how much risk is still on the table.
Yeah, always risk in the markets when you're investing. So carrying over from last month, these are still the main points that will likely impact you, those folks that are listening today. Inflation's growing still growing. Slower than it was in 2022, but we can't forget that it's still going up. Everyday items are increasing in price. Indexes are rising. That's good. We hope that that's a sign of improving health, but we want to see that breadth continue.
So what happens if both inflation and market returns continue going up and up and up and up? It can't keep going.
No, it can't. So bond indexes are struggling. Interest rates are still high. We know about that. And if you're looking to buy a new home or another large purchase, that's going to be a challenge. You're going to be able to afford less house. We are seeing personal credit card debt rise to all-time highs. And although money supply in the last couple of months is ticking up just a hair, but who knows, that could be the effect of refunds and things like that. So
we just want to make sure that you understand that we know the anxiety that can come during an election year with your finances.
Right.
So that's why I wanted to cover it.
Make sure you visit with your advisor and make sure your strategy is still the right strategy and how to navigate the volatility. Don't panic. Don't make decisions based on headlines. And especially avoid the political noise, because everybody's trying to paint the other candidate as a villain and the worst thing since Satan. So
notice how, everything on the headlines is all negative attacks on each other. It's like so and so did this, and so has mental capacity, whatever.
Yeah, and they can't say anything positive because they know that they've got to convince you that the other candidate is the Antichrist. so it's so we just have to adapt. We always encourage our listeners not to panic. Just take a deep breath. We still believe the U.S. future is bright, and financially and in our daily lives as well.
I always put a plant here on this slide because we're trying to grow over time. We're trying to grow these retirement assets. But what about your 401k? This is probably a big portion of your nest egg. You might be concerned about it.
Yeah, and so we have a number of tools that we can help you optimize your 401k. In fact, we call it 401k Optimizer.
Mm-hmm.
It's a service that we offer for folks that are building their 401k portfolio at work. You always need to make sure that you're taking a look at that. A lot of the tools that are available by the 401k providers are really just trying to make sure you stay invested all the time. And maybe you don't need to be invested at times. Wouldn't it be good to have someone to kind of help prod you with the right thing to do? Give us a call, text us at 254-282-0495, and we can introduce you to that tool and help you with your 401k. And you may have other options as well, depending on your age. So what does this mean for your financial plan? Well, take a look at your statements. Make sure you're not holding a bunch of things that are underperforming.
Mm-hmm.
And you need to take a look at that. Talk to your financial advisor or another professional. Educate yourself. And if you don't have a financial professional that you can trust, give us a call. We'll be glad to answer those questions for you.
If you buried your head in the sand this year because of the chaos, we encourage you to just open your statements and look at it and call us if you need help.
Yeah, you may be surprised and you may be surprised.
Yeah.
So take a look at those things and look at that. So I know we've had some questions coming in. When will rates lower enough for buying a house to be more affordable?
I wish we knew.
I don't know. I don't have a crystal ball. I think at some point there'll be enough pressure that rates will start to drop, but I don't know if that's this year, next year, or the following.
It could be a very long time before we see those 2020 and 2021 rates in the 2 and 3% range. That could be quite a while.
Well, here's another question. If the market dips in September and October, should I stop contributing to my 401k? No, because if the market drops, you're buying things on sale.
That's right.
And so keep contributing your dollar cost averaging. That's a good approach when it comes to your 401k. Don't stop.
Unless you're nearing that retirement runway and about to land, give us a call and we'd love to help you.
So here's one final question on the board, it looks like. What are ways I can avoid getting trapped by my credit card debt? Oh man, this is a great one. I'm reminded of the Saturday Night Live skit that Steve Martin did. This is how old it is, right? Steve Martin did in the early 1980s, and it was an infomercial to purchase a book called "Stop Buying Stuff You Cannot Afford." If you don't have the money, don't buy it. And that literally was the gist of the book. And I'm not trying to make light of those that are stuck in credit card debt, but that is the key. Stop putting stuff on credit cards. Don't buy stuff you don't have cash to purchase, okay?
And we can help with
consolidation
and planning to attack that mountain of debt if you have it. We'd actually like to help you with that.
But yeah, we can help you with that, but it's something that a lot of people they're like, I can't keep adding money to the credit cards. Like, well, you've got to change that habit, and that's something only you can do. But these are all great questions. If you have additional questions and think of them after we're done here, please give us a shout. Send us an email at info@clearvistafinancial.com. You can also text us. That's not on the screen there, but it's 254-282-0495. We try to get back to you the same day, if not within a couple of days, especially if it's on the weekend.
Right.
And if you just want to schedule a consultation with us, there's my calendar link right there. It's www.calendly.com/Mark Trice. Jesse, anything else you wanted to add before we wrap up today?
No, we'd love to communicate with you. I know we shared a ton of information. If you have any questions, please reach out. We'd love to talk to you about it.
All right, great. Folks, have a wonderful month. Call us with any questions, and we thank you for participating today.